In this lesson, we're going to dive into one of the most fundamental and widely used indicators in trading, moving averages. We'll cover both simple moving averages, SMA, and exponential moving averages, EMA, explaining how they work and how you can use them to identify trends and make informed trading decisions. Let's get started. So, what exactly are moving averages? At their core, moving averages are tools that help smooth out price data by creating a constantly updated average price. This makes it easier to identify the direction of the trend without the noise of day-to-day price fluctuations. There are two main types of moving averages we'll focus on today: simple moving averages, SMA, and exponential moving averages, EMA. Both serve the same basic purpose, but with some key differences in how they're calculated and how they react to price changes. Let's start with the simple moving average, or SMA. The SMA is calculated by adding up the closing prices of an asset over a specific number of periods and then dividing by that number of periods. For example, a 9-day SMA would add up to the closing prices for the last 9 days and divide by 9. This method gives equal weight to all the data points in the period. The result is a smooth line that follows the general direction of the price movement. Now, let's move on to the exponential moving averages, or EMA. The EMA is similar to the SMA, but gives more weight to the most recent prices. This means that the EMA reacts more quickly to recent price changes than the SMA does. In this example, you can see both an SMA and an EMA plotted on the same chart. Notice how the EMA stays closer to the actual price movements compared to the SMA. This quicker response to price changes makes the EMA particularly useful in fast-moving markets where you want to capture shifts in momentum earlier. If you want to see moving averages for yourself, then sign up for a free trading account on Kraken and get access to this and hundreds more popular trading indicators. So, how can you use moving averages in your trading? Here are some practical ways to incorporate SMAs and EMAs into your strategy. First, you can identify trends. The most common use of moving averages is to identify the direction of a trend. If the price is above the moving average, it suggests an uptrend. If the price is below the moving average, it suggests a downtrend. 2. Support and resistance levels. Moving averages can also act as dynamic support and resistance levels. Traders often look for price bounces off these lines as signals to enter or exit trades. And 3. Moving average crossovers. A popular strategy is to look for crossovers between a short-term and a long-term moving average. To sum up, moving averages are versatile tools. By understanding the differences between SMAs and EMAs and knowing when to use each, you can enhance your trading strategy and make more informed decisions. Thank you for joining me today. Keep practicing with what you've learned, and don't hesitate to revisit this lesson if you need a refresher. See you in the next one, where we'll continue building on these concepts.